The U.S. job market is sending mixed signals, with recent data revealing a subtle tug-of-war between employer caution and worker stability. Here's the catch. While new applications for unemployment benefits have edged upward, they're still hovering in a range many economists consider reassuring. But here's where it gets tricky. This modest increase hints at a broader economic slowdown, even as companies hold on to their current workforce. Let's break it down. Last week's numbers showed a rise of 8,000 claims, pushing the total to 237,000 for the week ending August 30th. That's slightly above economists' predictions of 231,000, but still comfortably within the 200,000 to 250,000 range that's been common since the pandemic. Think of this as a barometer for layoffs. If the number stays below 300,000, it's a sign the labor market isn't collapsing. But don't let the numbers fool you. This isn't all good news. The economy is clearly shifting gears, and companies are adopting a wait-and-see attitude. Hiring has stalled, creating what experts call a no-hire, no-fire economy. Yet the unemployment rate remains stubbornly low at 4.2%, a paradox that leaves many scratching their heads. And this is the part most people miss. While jobless claims stay steady, the broader labor market is showing cracks. For example, the number of job openings dropped to 7.2 million in July, fewer than expected. And the July jobs report was a shocker, with just 73,000 new jobs added. To make matters worse, previous months' numbers were revised downward, eroding confidence. This isn't just a statistical hiccup, it's a sign of deeper uncertainty. Companies are pulling back on expansion plans, partly due to the looming shadow of President Trump's tariff policies. Growth has already slowed to 1.3% in the first half of the year, a stark drop from 2024's 2.5%. Now here's a controversial twist. Trump recently fired the head of the agency responsible for compiling jobs data. Critics argue this move undermines transparency, while supporters claim it's about accountability. What do you think? Should political leaders have the power to influence economic reporting, or does it risk distorting public perception? Share your thoughts below. The stakes are high. The Federal Reserve is closely watching the job market, and Chair Jerome Powell hinted last week that a rate cut could be on the horizon. A cut might lower mortgage rates, car loans, and business borrowing costs, potentially giving the economy a much-needed jolt. But it's a delicate balancing act. Ease too much, and inflation could spiral. Act too late, and unemployment might rise. The August jobs report, due out this Friday, will be the next big test. Economists are betting on a modest 80,000 new jobs, but the truth could be more volatile. Let's not forget the human element. The 4-week average of claims, a smoother metric to filter out weekly noise, rose to 231,000, and the total number of people collecting benefits fell slightly to 1.94 million. These numbers aren't just digits. They represent real people navigating an uncertain job market. For now, the economy is limping forward, but the question remains, how much longer can it hold this fragile balance? Your turn. Do you think the Fed's rate cut will help? Or is it too little, too late? Sound off in the comments.